In this video, I'm going to go over a few things that you'll need for problem 3 that you didn't need for problems 1 and 2. Actually, problem 2 did have a loss payout. So in this video, I'll show you how to do the loss payout, how to calculate premium when it's written evenly over the year, beginning 7/1x1, and how to handle the investment income rate. Both the premium written evenly over the year and the investment income rate are seen for the first time in problem 3. So let's go ahead and start with calculating when premium is written evenly over the year. Note that premium of $3 million is written evenly over the year beginning 7/1x1. In the face-to-face course, I would take the time to explain how to calculate the earned premium when premium is written evenly over the year. But in the interest of time and the delivery method for this course, I'm not going to require you to calculate the premium earned when it's written evenly over the year, but I am generally going to explain it. Basically, when premium is written evenly over the year, if we were doing this using exact assumptions, we would divide 3 million by 365 because there are 365 days in the year. And we would assume that 1/365th of 3 million is written every day. But even that is too complicated for our purposes. So what we assume is that 1/12 of the 3 million is written each month. 1/12 times 3 million equals 250,000. So we assume that 250,000 is written every month. So we know if it's written 7/1x1 that by the end of the year, 250 times 6, or that written for the months of July, August, September, October, November, and December, that's 6 months, 1, 2, 3, 4, 5, 6. Those are all written during X1. So that's 1,500,000, or half of our 3 million. We'll put that here. And the other 1,500,000 is written in X2. Now let's look at the calculation of premium earned. Again, I'm not going to explain the specific math behind this, but I'm going to give you the general idea and the concept of why we do this. Since we know that $250,000 is written every month for 12 months, starting in July, each one of those premium writings has a whole year to earn. Let's use numbers to represent our months again. July, August, September, October, November, December, and then January, February, March, April, May, and June. All 12 of these writings earn at different times. Each one overlaps the other. But if we assume for simplicity that the entire 250,000 is written on July 15th or in the middle of the month, then we can come up with a fraction or percentage of this written premium that earns by the end of the year. As it turns out, and this is where I'm skipping over a lot of steps, when we have written evenly over the year beginning 7/1x1, the fraction of the total written premium of 3 million that earns by the end of the year in the first year is 1/8. That is mathematical, and I'm not going to take the time to show you here. But 1/8 times 3 million will give us our premium earned in X1. 1/8 of 3 million is 375,000. So we'll put that here. And because this is symmetrical, in the third year, 1/8 earns as well. So let me show you the exact formula for calculating premium earned. So this is premium earned when premium is written evenly over the year beginning 7/15x1. The fractions are for year 1, 1/8 of the total premium written for both years, in this case $3 million, 1/8 earns. So that's earned premium for year 1. For year 2, 3/4 or 75% of the total written premium, again, your 3 million equals the earned premium. So we already calculated 1/8 times 3 million equals 375,000. Put that back up here. And 3/4 times 3 million equals 2,250,000. So now let's look at the loss payout and how to calculate losses paid and loss reserves. Remember that we take the loss ratio of 60% times premium earned of 375,000. I'm getting that here. And that equals 225,000. But note over here that our loss payout was 30%. That percentage is the percentage that we pay out in the first year. So 30% times our losses incurred, which is what this is, times 225,000 equals 67,500. That is our losses paid. The rest of 70%, that's why I put this fraction here, 30/70, means the 30% is paid in the first year and 70% is not paid until the following year. So 70% times our 225 equals 157,500. Again, that's 70% times 225. It's also the difference between 225 and 67,500. So where do we put each of these? Let's go ahead and account for our losses. Every time you want to put losses incurred here. Now in a subsequent problem, you'll have a discount rate, which will affect this number, but I'll explain that in a different video. So we'll go ahead, and we don't have a lot of room here, but we'll put our 225K here. That's our losses incurred. That comes out of income, which makes sense because we have to recognize those losses as we reserve them, not just when we physically pay them in cash. We recognize the entire 225. Part of that we pay, and that comes out of cash. So that's our 67,500, our losses paid. And part of it we reserve. Now again, pay attention to where the debits and the credits go. We debited income because on the liabilities and owner's equity side, a negative is a debit, and we credit cash because again, that's a negative, and this is the asset side. And we increase or credit, we're on the liability side, our loss reserve here for the difference of 157,500. So we're setting up a loss reserve for what we know has been incurred but we haven't paid yet. And that's how we deal with the loss reserve. Now in the next year, I'll go ahead and show you how to handle this, but you will have to figure out how to do the loss payout for the second year in the second year. But in the second year, we now have this 157.5 that we have to pay. So we simply pay it out of our cash account, 157.5 here. And our corresponding entry is a reduction in our loss reserve. Be very careful here because your loss reserve in the first year is going to be 157.5. In the second year, because in this case you're zeroing this out, the loss reserve is 0. You're taking the 157 credit here and subtracting that from 157.5 for the first year, and that gives you 0. Now the last thing is to figure out how to account for the investment income rate. In the first year, the way that you account for the investment income rate at 8% is we're going to assume that 8% is the average earned on all your assets. And by the way, one thing I didn't point out in the first problem is that we assume that there are no accounts receivable, so that when we take in premium, we take it in all as cash. But we're going to assume, in this case, that our return averages out to an 8%. So we take 8% times our 1.6 million. So this equals 128,000. We're going to put the 128,000 in income. It's a credit to income because we did earn it, and in cash because we actually get the cash. A debit to cash, which is an increase in cash, and a credit to income. To help you along a little bit, I'm going to give you the total that you should calculate here. 2,560,500, which of course should be your balance over here as well. So given that 2,560,500, your investment income for the second year will be 204,840, also known as interest earned. And again, that will go here. Can't really fit it there very well. And here, 204,840. In the last video, I'll go through an example of how to calculate the discount rate, but now you should be able to do problems 1 through 3 without any additional information.